Thank you for tuning in to the Starkey Multifamily Podcast. I have with me Bryan Ellis. Bryan is the host of Self-Directed Investor Talk, a podcast for self-directed IRA and solo 401k users, and the CEO of Self-Directed Investor Society, a private association for affluent investors. He is also known as an expert in self-directed IRAs, solo 401ks, and 1031 exchanges writing. Bryan's writing can be found in Forbes, Entrepreneur, TheStreet.com, and other highly regarded publications. He also teaches legal education courses to licensed attorneys through CEB, the Legal Continuing Education Division of the University of California. He lives in Metro Atlanta with his wife and business partner, Carole, and has 4 children ranging in age of 4 to 21. Bryan has also raised millions of dollars for syndications. This year he's committed to over $55 million. And he also does webinars, teaches how to do webinars to raise some of these money, charges up to $25,000 per day for some of that training. So Bryan, thanks for joining us. How are you today?
My pleasure. I'm doing very well, Reed. Thank you for having me.
So Bryan, let's get started. You got quite an interesting resume. We were talking a little bit before the show. Tell me, how did you get started into all this raising money and 401ks and all that stuff?
Well, the self-directed IRA part came first. You know, this was back in the late 90s and early 2000s. I was a real estate investor, a single-family real estate investor, and somewhere along the way, I learned that you could use self-directed IRAs to do real estate deals, and that was pretty earth-shaking for me at the time. And again, this part was in the late 90s or mid-late 90s. And I immediately realized, you know, if I could use my own money to do real estate deals, you know, the money in my retirement account, it's probably also going to be possible for me to use the money in other people's IRAs or 401ks to do my deals and come up with a win-win scenario. And so I did that and got a lot of practice using IRAs and 401ks, both my own and others. Actually, it was pretty much exclusively IRAs back then. The 401ks really didn't come around until the early 2000s, the solo 401ks. I did that, did a lot of it, and it worked out nicely. But over time, it turned out that the part of the process that I enjoyed the most and was the best at was the part dealing with raising capital for larger capital projects, real estate projects, oil and gas projects, private equity deals, et cetera, et cetera. And so the net effect is that we built a large following and still have a very large following in the self-directed IRA world right now. My podcast, Self-Directed IRA Talk, or Self-Directed Investor Talk, is by far the biggest and most successful podcast there is for self-directed IRA 401k users. We also have published the only print magazine in the country for self-directed IRA and 401k users called Self-Directed Investor Magazine. We still do all that to this day because that's a profoundly important market segment. But we also introduce those people to alternative investment opportunities. And that's where the capital raising side of the business meets the self-directed retirement account side of the business. And that's what I do to this day.
So you've gotten all those people, following you and coming to you through all your platforms. So you've got, your podcasts and the magazines and the writing. That's many years of hard work to get that network. If somebody wanted to get into raising money, either for themselves or for somebody else, where would they start? So they don't have a network, they don't have, all these connections, they don't have a platform. Where would the first place you'd tell them to go?
Yeah, that's a great question, Reed. And I'll answer that with a little story. I have a colleague who is actually, he is himself a securities attorney. So he knows the law about this stuff really, really well. He's also a very, very accomplished real estate investor himself. And not long ago, this was back in 3 or 4 months ago, I guess, he hired me. He was one of the people that, we do this thing where I spend a day with my clients for 25 grand. And at the end of that day, we hand over a webinar to them that they can use to raise capital. And it tends to be a very persuasive, very effective webinar because I've been doing this for 20 years now. And in that case, he had to deal with the issue you're talking about. Now, he did have a database, but he had already kind of mined his database. He had already raised $6 million from his own database. And what he needed was to have a way to raise money from people who didn't yet know him, like him, and trust him. So this is how effective this stuff can be, Reed. In that scenario, what happened was I created a webinar for him. You know, we did the typical thing where I go in, spend many hours with him and his management team, really get all the information about the project. Then I create the webinar. But we also had something else going on in the background while we were doing this, and that was just a little Facebook campaign to generate new leads, new people who were not already in his database, who were not already his followers. And those are the people that we invited to the webinar. We also invited his database to the webinar. You know what? It was astounding, Reed. There were so many people. We raised more than about $3 million in 72 hours. And it was largely, most of that was from people who 72 hours previously had never heard of me, had never heard of this guy, had no knowledge of any of us. Now, the reason I say that is because it certainly gives you a huge leg up if you have a database, if you want to raise capital, no doubt about it. And that's where you want to be. Mm-hmm. But even if that's not where you are, you can start from a standing start and raise capital if you have a good deal and a way to persuade people that your deal is worth their interest. And that is, in fact, what I do at we do a 2-day training called the 1-Day Capital Raise. And that's exactly what it is teaching people how to go from a standing start all the way to being able to raise large amounts of capital very quickly.
So it's definitely a big raise for somebody. I mean, that's half of what he had raised prior to that. Yeah. So if somebody so they're starting off, where would they get the education? So you can do the course with you, the 2-day course. So they would do the webinar. Maybe can we do some touch points of how that webinar would look or how that campaign would look?
Oh, sure. Yeah, by all means. So in the 1-Day Capital Raise model, I'll just kind of go over the 5 steps that I teach very, very quickly. Step 1 is lead generation. That's the part you were just talking about. We spend a fair amount of time on how do you go from having nobody who is presently interested in investing in your deal to having people who are. That's what lead generation is. The second step is the webinar itself. This is where all the real work gets done. I'll come back to that in just a minute to talk about how my webinars are different, because mine are radically different from every other capital raising webinar you've ever seen. And you'll see that pretty clearly when I share that with you. But after the webinar, the call to action on that webinar is to do a one-on-one telephone call with me or a member of the staff or my client or their staff, because you want to make sure that you're dealing with somebody who actually qualifies both in terms of accreditation, capital availability, their needs and objectives. You need to make sure you're actually dealing with the right people. And from this point forward, you won't ever talk to anybody again who is not a really well-targeted prospect. The 4th step, after lead generation, after the webinar, and after what we call the disqualification call, the 4th step is a small event. I teach my clients to have a very small event, usually 5 to 15 people. And these are the people who have made it through the process so far. They've been lead generated. They've gone through the webinar. And they've also done the disqualification call. Those are the people that we invite to a small event, usually at the location of the project itself. We let them see the project. We let them meet the team members. We basically just make sure all their questions are answered. That's the 4th step. And the 5th step happens the same day. The 5th step is at the end of the day when we actually get them to sign their name on the dotted line and commit the money. We cover the entire process, all 5 steps, beginning to end. And that's a unique model. Most people don't use a live event model, and nobody uses webinars the way that we use them. I mean, for example, if you've ever been on a capital raising webinar for someone else, chances are very, very good that you've seen people put at the beginning of that webinar a screen that lists probably the name and the photo and 3 or 4 or 5 sentences about the background of each one of the general partners or the key people in the management team. Everybody does this or some version of this. Well, it's a crazy thing to do. Like it makes no sense. The reason it makes no sense is because at that point, nobody knows you or cares about you or has any interest in what you have to say until they know they're interested in the deal.
Right.
And that's counterintuitive. Like, investors like to say really pompous, self-serving things like, I invest in the management, I don't invest in the asset. Well, that's malarkey. You invest in both. Neither of them matter without the other being good. But the problem is the management team doesn't matter at all until the asset is an interesting and attractive asset. So that's where you start. You start with what the people are there for. And then you share the other information when it's relevant in context, because they do want to know who the management team is. They do want to know what your background is, but they don't need to read a resume. And if they're reading the screen, they're not listening to you. There are a million different little examples of how we do webinars differently, because I understand how the human mind works, and it is not a rational process. It is not rational in any way. So we create these presentations to be structured to speak to the way that people think. And it's a rationalization process. It's not rational. And everybody else thinks it's rational. Everybody else loads you down with data, way more than you could ever process. We don't do that. We give you exactly what you need to get to the next step and focus very, very intently on making sure that you know if this is or is not good for you, because they're both valid decisions. And if this thing is good for you, we focus very intently on helping you know that you probably need to respond right now, because tomorrow might not be the opportunity that today is for you, right? So that's the 50,000 foot overview, and it has worked incredibly, incredibly well. And it's basically the model, the structure that I have developed over the past 20 years of doing webinars and teleseminars, and it's a powerful thing.
Yeah, so that's interesting what you say, because that's when you talk about how much information and the order of information. Dan and I, my partner Dan, was just talking about that yesterday. Is what is too much information? What is too little information? Because you give them too much, and people are just going to daze out and lose interest. You give them too little, and they might think you're hiding something, or you won't hook them. So what do you feel is the right balance of information?
The right balance is almost always far less than you think it is. And it always shocks people to say that. I tell people that a good generalization is anytime you think you need to put a spreadsheet on the screen, because a lot of people do that. They'll put a spreadsheet that says year one expectations, year two, year three. This is the pro forma basically. Mm-hmm. And maybe they'll do 5 columns for 5 years. This happens all the time. Very, very common. Nobody's going to read all that data. What they're going to do is look at individual pieces of it, start wondering things about that piece of data, and then maybe look at another one, and all the while they're not listening to you. The most important part of a webinar is the words that are being said by the speaker. That is far and away the most important part. So if you're thinking about putting a pro forma on the screen that has 5 columns, and this is year 1, 2, 3, 4, 5, and there are several lines, everybody does it. Don't do that. Pick the line, pick the number at the upper left, pick the number at the lower right, and compare them. That's all you need. The pro forma information, that needs to be in the PPM or somewhere else in the documentation. It does not need to be in the webinar. You're just going to drown people if you show them all of that information right then. Small chunks, and very few chunks. That's really the idea. And the more you can give the information in the form of a story, the better it's going to be. And it's easy to do that. I mean, there is a story behind every deal. How'd you find the deal? How'd you qualify, decide it was a good deal? What made you think about rejecting it? What other deals did you reject on the way to getting to this one? What other deals have you done in the past that were like this one that worked out? Well, those are all stories. And if you tell them as stories, it becomes very, very easy for people to follow, and they're motivated by that. I mean, that's why all throughout human history, people have told stories to express information and to lead change. So that's what we do.
I think the storytelling is something that the investor wants to do as well. So the investor wants to take that story and tell their friends and say, they don't want to say I invested with Bryan because he's a good friend of mine. He seems real nice, and I talked to him. That's no fun to tell that story. You want to tell the story of, maybe a dilapidated building that was purchased and you brought it up to this amazing Class A, asset. That's maybe a little extreme, but that's what people want to say. Or, like you talked about other asset classes. You want to talk about, maybe a vacant land that became an RV park or something. So
right. Yeah, the whole idea is that the human mind works in a particular way. Like the way people think we make decisions is not the way we actually make decisions. And so the way that we create our webinars is a reverse engineering of the thinking process. And so that's how we present our information in the way that the brain already processes it. And so that there's just not a lot of friction. We make it really easy for people to know if they should be playing this game or not. And if they should, then we leave them with clear impressions about what this thing is all about. And it's hard to say no if that person is qualified and it's right for them. I mean, just last night, for example, just like literally last night, I did a little webinar to a small group of people. It was only about 10 people. And these are 10 people that I have never had a private conversation with ever. Like, I don't know any of these people. And these are also people who have never invested in the particular asset class that I was discussing, which is oil and gas. And the project that I was sharing with them has a $150,000 buy-in. So it's not a small dollar thing. Well, 4 out of the 10 of them said yes. Well, that's a pretty high number. That's not the highest we've ever seen, but getting 40% of the people on the line to say yes, well, it's actually not that hard to do whenever you have reasonably well qualified people on the line, and you speak to them in a way that makes them not have to think about it, where it's like instead it's an automatic slam dunk where they think to themselves, I'd have to be crazy not to be interested in learning more about this. That's all we do.
Yeah. So, earlier you talked about, 10 to 15 in a group, like a small group for an event.
Yep.
So how many people are you targeting for a raise? Does that number change depending on the value, or are you trying to get larger dollars for a larger investment, or more people for a larger investment?
I would generally rather have fewer people. A lot of the raises that we're doing right now it's kind of odd. A lot of them that we're doing right now, particularly in the oil and gas space, they're $1 million, $1.5 million. So they're not very big. And most of those are 10 people. They're typically divided into 10 units. There's another project that I'm about to start raising for. It's a big oil and gas deal of a totally different nature. And the cash or the equity side of it is 15 million. And in that case, we're certainly going to have more than just 10 units, but it is my hope in that case to get larger investors involved. And I expect I will. I mean, the last time I raised a fund of my own that I also managed, our minimum investment was $250,000, and we didn't really have any trouble filling it at that. So, a lot of investors are very scared in the beginning to put a minimum of $250,000 or even $100,000 on their project because they think that they won't be able to find people who can put up that much money. And the thing is that there's 2 ways to think about that. One of them is that you're never going to succeed if all of your capital raising is based on who you know right now. So you're going to have to expand your network anyway. So you may as well do it now. And you may as well do it to people who can write bigger checks, because there are a lot of people like that. But the other thing about that is no matter what you put as your minimum, it's almost always the prerogative of the sponsor or the project manager or the general partner to take less if they want to. So it's not like it ties you down. It's not like if your minimum is 250 and somebody has 175 and you want to take that money. It's generally not the case that you can't do that. It's just that that's not the number you're leading with. And I'm going to tell you, whenever you lead with a 250 minimum, you get 250 quality people. And that's kind of important.
That's an excellent point. You get the 250 quality people. So that's kind of, you're only doing accredited investors. So you're doing 506Cs, right? Because you're targeting people that you don't necessarily.
I only do 506Cs when I don't do projects just of my own anymore. I just do the capital raise, but I have two partners that I work with. And whenever the three of us do a project, always 506Cs. A lot of my clients do 506Bs. I never recommend that. But even when that's the case, it's easy to use my model still. We won't go into why right now, but one of the things that I teach in the one-day capital raise training is that you need to decouple your marketing strategy from your capital structure. And what that means is that you can use the same strategy regardless of whether you're using a 506B or a 506C. It doesn't really matter, because we're not pitching the deal necessarily on the webinar. What we're pitching is come to an event, learn about other things that we've done in the past and things that we might be able to do in the future, but we don't even invite people to that thing until we've already had multiple conversations with them and can demonstrate that we have an existing relationship with them, which is what 506B requires.
Right. Yeah, I agree with you. So Dan and I have talked about that quite extensively, because really everybody in the market that we talk to is doing 506Bs. And truthfully, we can't truly justify why that makes any sense. We feel personally, and maybe you can put your opinion on it, that it kind of handcuffs you. So, most of the people who, if we're asking for 50,000 a minimum, and like as you suggested, even up to 250, there's not many accredited investors that I would feel comfortable taking 50 grand or more from, because that's a large portion of their net worth, and maybe all of their liquid cash for that matter. So maybe, what were your thoughts on the advantages and disadvantages of those?
I don't see any advantages to 506B. I know what the theoretical advantages are. You can have the 35 unaccredited investors, the 35 sophisticated investors. That's about it. The compliance burden that places on you is not worth the theoretical convenience. And that's particularly true since our marketing methodology makes it possible for you to completely disregard what capital structure you're using. We market the same way regardless, but still, from a legal point of view, as a practical matter, as a project sponsor, as a general partner, you have to look at it and say, which capital structure is the one that lets me raise the money that I need, have the control that I need to have, and also represents the least risk of trouble. Well, the least risk of trouble is a big consideration, and there is no reasonable way you can say 506B is the one that leads to the least risk of trouble. So
the big complaint that I hear from people with the 506B is that people don't like the extra paperwork of proving they're accredited. What's your thoughts on that?
Well, in 506, so you're talking about in 506B whenever you take in actual accredited investors.
Yeah, so there's less hassle for them to join a 506B than a C. That's the feedback from the people that are pushing the 506B.
I've been doing this a long time, and I've done a lot of raises. I've literally never heard an accredited investor say that I'd rather do a 506B because I don't have to do the paperwork.
Well, I will believe you. You definitely have the advantage on that. So that's good to know. And, kind of what I want to tie into as well is I see a lot of 506B people severely putting themselves in risk with their communications on Facebook about what they're doing.
Oh yeah.
Hey, we just got this 506B under contract today, which, I've never heard anybody getting in trouble for it, but, from what I've been told, that's pretty clear, not allowed. So what are your thoughts on some of the illegal stuff or questionable stuff that's being done in the 506B world?
It's astounding. The reality is that most sponsors and general partners, particularly in the multifamily world, there is an astounding degree of ignorance among people who are doing multifamily syndications. I would not do a deal with somebody who hasn't been doing this for at least 5 years. I want somebody who has messed up, who has, kind of gotten kicked in the teeth and learned from it. You're probably going to mess up your first deal or two somehow. It may be major, it may be minor, but you're going to mess up something.
Mm-hmm.
And I want you to learn that lesson on somebody else's dime, not mine. And that's not to say that people who are new to it aren't going to do a great job. I'm not suggesting that in any way. I'm just saying that from my perspective, that's what I would look for, somebody who's done a fair amount of it. And the thing is that just about nobody has taken the time to actually talk to their attorney and say, if I do this wrong, what's going to happen to me? Well, let me tell you what could happen to you. If you do it wrong enough, there's going to be a team of people with guns strapped to their side show up at your house or your office and take away all your computers and put handcuffs on you. That really is what could happen. It's the worst case scenario, granted, but that is what could happen if you run afoul of the SEC. That's not a game you want to play. And the thing is that this sort of stuff doesn't really tend to happen that much until you've lost somebody's money.
Mm-hmm.
Once you've lost somebody's money, and that is going to happen from time to time, it's just part of the game. Once you've lost somebody's money, now they have incentive to go to their lawyer and say, lawyer, look at this person and see everything they ever did, and let's find a way to attack them and get my money back and a lot more. Well, these people who are going out on Facebook and talking about their deals, we got a deal under contract, or we just got fully funded, or whatever. I mean, that is just stupid. I mean, it's like ignorance of the highest order. But that's just my humble opinion.
Well, and that's the main reason we like to see, is because we don't have to be so cautious. We can tell people what we're doing, which, it's what we do, especially having platforms like we talked about earlier, having meetups and podcasts. I talk about what I do, and I don't always know those people. Sometimes that's the first time I met and they ask what I'm doing, and I don't want to have to hinder and think about, okay, should I talk about this? Can I put this on Facebook or that? So I think that's a good point, but.
Well, to me, it's that is the issue. But to me, the issue is kind of more nuanced. It's not about whether I can do the marketing, because I can do the marketing. Like, it doesn't matter if a deal is a 506B or a 506C. The marketing model we use in the one-day capital raise is agnostic to the capital structure. It does not matter one little bit. But still, the 506B presents more opportunity for you to have trouble in the future. There's no denying that.
Right.
That's the reason that I think it should be avoided.
Got it. So I'll segue into another topic that's pretty big in the concern of what's legal and what's not. So raising capital, and how to structure that in a deal. So it's kind of being argued that bringing on somebody just to raise capital is not legal, because they don't have any they don't have their dealer broker license.
Mm-hmm.
So how do you get around that? So you raise capital for lots of people. What
Mm-hmm.
are you doing to protect yourself in that direction?
Yeah, good question. So number one, I'm not a lawyer. I do teach lawyers the law about self-directed IRAs, but I'm not a lawyer. So you got to take everything I say with a grain of salt, because I can't give legal advice. Having said that, I have had lots of conversations with lawyers. There are a number of securities attorneys who are not just my attorneys, but also my friends. And so this is something that has come up a lot. And here's the bottom line. If you are a broker dealer, you can charge commissions for raising capital, period. I mean, like The law provides for that. If you're not a broker-dealer, you cannot charge commissions for raising capital. And so I don't charge commissions for raising capital because I'm not a broker-dealer. I charge fees for services. I charge $25,000 to sit with them for the day to create a webinar for them. If they want me to actually raise capital, it's kind of a beast to work with me, honestly, because if somebody wants me to raise capital for them, they're not allowed to pay me on the basis of my raising capital, of whether I'm successful or not. So what they have to do instead, they have to pay me in advance.
Mm-hmm.
They have to go ahead and pay me, or we have to go ahead and set terms, exact terms of what I'm going to be paid, regardless of whether I raise the money or not. And then I can do it. There's more nuance to it than that. But the bottom line is that I am not compensated on the basis of whether I raise capital or not. I do a fee for service arrangement. And again, like I said, there's more to it than that. But you can't charge 3, 4, 5, 10%, or whatever the number is for every dollar you collect unless you're a broker dealer. If you are, you can, but that comes with other strings that are probably a little more than most of us want to deal with.
Yeah, that's certainly one of the biggest hurdles, I see a lot of people challenged with, because that was pretty much an industrial standard. I think many people are still doing it, where they take a portion of the deal and they say, whatever you raise, this is, either equity or, just a flat commission. But
yeah.
For a while, people argued that equity was different than the commission, but I think that's been a little defunct by now. So I see a lot of people struggling with that. And yours is definitely the cleanest way of doing it, having a solid fee, because that is clear that is allowed, because it's not performance-based. So I'm glad to see that that's the direction you're going.
I am terrified of getting a knock on the door from the SEC. We just don't. Whenever there's black and there's white and there's gray, and gray doesn't mean you're breaking the law, but I don't even want to get near the gray.
Right. Well, and yeah, and we appreciate this. So Dan and I are also, very, we struggled with that for a while, because Dan wanted to do just capital raising. And then the more he got into it, we found out that it's a very difficult thing to do legally and correct. So we kind of partnered up that way, and I wanted to do the deals and find the deals, and that became a good partnership that way. So we're involved in the whole aspect, and that's how we make it work.
Yeah.
On our side. So
Yep.
We're both involved in all aspects. He goes to the property tours, but essentially his role is to bring the money in, but he's involved in every other aspect as well. So that's how we get around it. But
yeah,
that's
absolutely.
Definitely something that scares me. There's a lot of people out there doing it far scarier and riskier than what you and I have discussed. So
yeah, you certainly can't take your cues from what's popular.
No. Well, that was another frustrating part that Dan and I had found. So when we started calling attorneys, we would call one attorney, he says, oh yeah, as long as you do this, you're covered. And then talk to another attorney, they're like, no, you absolutely cannot do that. That's completely illegal. Here's the code that says it's illegal. You cannot do that. And then, we talked to like 6 attorneys in one day, and not one of them gave us the same answer. So, then we're going, well, where do we go from here? We don't know what's legal, but after a while we put the pieces together, and we've come to just what you said, that yours is definitely the cleanest. And then having partners that are fully involved in the actual ownership and management of the company, both make sense. But again, like you said, don't take my legal advice, talk to your attorney.
Right. Right.
So great. I think that's excellent advice. So Bryan, tell us a little bit more before we go. I want to talk a little bit more about that program, if somebody wanted to bring you on to create their webinar. So are they paying up front for that? Are they paying out of the closing, or how does that work out?
No, they pay up front for that. That's not, I'm not participating in their deal.
Okay.
This is usually best for folks who have done this sort of thing before, in terms of running a syndication, or they, most people doing their first syndication, they have this wild idea that just because they found a good deal that they're going to be able to raise the money to fund it.
Mm-hmm.
that may have been true a few years ago. People are a little smarter now than they were 5, 7, 10 years ago. Back then, it was a rare and unusual thing to have an alternative investment opportunity. Today, not so much. Today, the people who are able to write $100,000 or $250,000 check or whatever, they're being pitched by more than just you, in all probability.
Mm-hmm.
And they also, whether they're being pitched, they definitely have lots of investment options, even if it's just to put that money back in the stock market. So the people who tend to hire me are the people who really get it, that you've got to make every exposure count to your leads. Like the example of the guy that I mentioned to you earlier that he brought me in because they were up against a gun. They or under the gun, I should say. They had about 10 days, as I recall, to raise somewhere on the order of about $2 million. And if they didn't, they were going to lose a big chunk of earnest money, and they were going to lose a massive deal. That was a great deal that they didn't want to lose. And so I get called in frequently, either at the very beginning of a project when it's a syndicator who's been there, done that, and they understand that you really need to make every single exposure to prospects count.
Mm-hmm.
And then I also get the call whenever somebody is up against a hard deadline, and they same situation there. They've got to make sure that everything they do with every day they've got counts the most. That's where I shine.
And are you coming out to their location to do this?
Usually they come to me.
Okay.
Usually they come to me here in Atlanta. Occasionally I will go to other places, but that's the exception, not the rule.
Okay. And then this is kind of a whole day, and everything's covered in the one day, and you're able to get them set up, and then they can roll from there.
Yeah, I mean it's all covered. Sometimes it takes into the next day to finish the webinar, but if we're under the gun in terms of getting a presentation ready for the next day, for example, well, I don't miss those deadlines.
Okay. So typically, we talked about your fee, but how much is usually expected to be an investment for, and obviously this depends on the size that they're trying to raise, but let's say I'm trying to raise $3 million and I bring you on, how much money am I going to spend on the advertising and the webinar portion beyond that?
Well, what you've got to have beyond that is you've got to have some people to get on the webinar. So you've got to have a database of your own, or you've got to have a budget or some other means to drive people into registering for that webinar. Mm-hmm. And that's probably, it depends on how much money you need to raise. I mean, if you're talking about $3 million, that's exactly how much we raised in or almost exactly how much we raised in the example I gave to you earlier. We raised about $3 million in 72 hours. And more than half of those people were brand new leads that came from Facebook. In that case, I'd have to check because I didn't spend the money. I advised them on what to do, but I didn't put in my credit card. They did.
Okay. I
would be shocked if they spent more than $1,000 on that lead generation, but I'd be willing to spend another 25 on the lead generation if you're really under the gun and it's justified, but you probably won't have to. You probably won't need anywhere near that much.
Okay. Well, it sounds like a good program. I can definitely see where it would fit in, especially, if you're under the gun or, you're concerned that you might not be able to get to the number or your target. I think it's certainly better than bringing on, like we had mentioned earlier, and a capital raising partner. So yeah. I think that's definitely a great way to go. So how can people reach out to you, Bryan, if they want to do something like that, or if they want to get a hold of you?
They can reach out to me at onedayraise.com. onedayraise.com. The number onedayraise.com.
All right. And then what's the turnaround time on that? If I called you today, like you mentioned, if I was under the gun in the next 10 days, how quickly could we get moving on that typically?
Well, if it's the case that my calendar is amenable, and I try to give priority to these types of projects. it's frequently the case that you know, if you can be on the plane tonight and meet me tomorrow morning here at my office, then we'll do that.
Okay. Well, very good. Well, definitely, reach out to Bryan, give him a talk. If you're raising capital, I think that's going to be a great direction to go. So, Bryan, thanks for coming on. Is there anything I missed? Anything I want to contribute?
No, that's great. It's been a pleasure. And I guess the only thing I would add is that a lot of people don't really want me to create their webinar because they want to learn how to do it themselves. And for those folks, those folks would benefit from coming to our training event, our 2-day course. Not only is it a lot less expensive than that, but they learn how to they learn how to do the entire process for themselves. It's more of a teaching them to fish rather than fishing for them.
Can they find that information on the same link you gave?
Yep. OneDayRaise.com.
All right, we'll check it out. OneDayRaise.com. Bryan, thank you so much.
Thank you, Reed. It's been a pleasure.